Welcome back to Alpha Recap, your weekly market-closed rundown from stockalpha.ai. Markets closed for the day, and we're unpacking the big themes from our Alpha Research coverage between June 26th and June 28th. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to dig into this week. AI headlines, valuation crosscurrents, and some pretty idiosyncratic moves in healthcare.
So, what really stands out here is that AI showed up as both a growth engine and a stress test for companies. Analysts kept pointing to faster AI adoption, but also to the hard questions. When does that turn into real revenue? And what does it do to margins?
Exactly. When you step back and look at this, firms from networking-style software to platform names are describing AI as a structural shift, not just a feature drop. But turning model adoption into predictable cash flow is where the rubber meets the road.
Give us the headlines. What were the dominant themes the research team flagged?
There were 5 big threads. 1. AI as both a near-term revenue accelerator and a longer-term platform play. 2. Valuation bifurcation. Some leaders trading at premium multiples, while a batch of software names sat at compressed valuations. 3. Execution, guidance, and liquidity breaking winners from laggards. 4. Healthcare staying durable but driven by discrete catalysts. And 5. Data gaps. Splunk was called out as having missing public metrics, which widened model uncertainty.
Right. Let's unpack the AI story first. Which companies are showcasing that transition best?
Twilio, DocuSign, Bill, Okta, and NVIDIA were all central to that narrative. Twilio is repositioning toward AI-powered customer engagement. DocuSign is pushing intelligent agreement management and striking AI partnerships. Bill is explicitly reorganizing its go-to-market with AI-native monetization and even hired a new chief revenue officer. Okta faces a debate around agentic AI monetization, meaning how much of identity will be sold as platform consumption versus wrapped into licensing models. NVIDIA, of course, remains the backbone for AI compute. The common thread? Revenue mixes are starting to shift from pure subscription to consumption or platform economics. That has implications for headline growth rates and margins. Consumption can boost top line, but it can also add cost volatility.
So if a company moves from recurring subscriptions to more consumption, it could look like growth in one quarter and pull back the next?
Yeah, that tracks. Consumption models often add seasonality and back-end costs, so margins depend on scale and how capital-intensive the compute is.
Let's talk valuation. You used the word bifurcation. Which names fell into which bucket?
In the premium durability bucket, you had companies like NVIDIA, Intuitive Surgical, and Eli Lilly. They traded at elevated price-to-earnings ratios, reflecting leadership positions and durable cash flows. On the other side, software names like Globant and Bill were trading at compressed multiples, Globant near multi-year lows and single-digit forward multiples, Bill at sub-11 times forward price-to-earnings ratio. Analysts framed this as a split between premium durability and value through execution.
That's a stark contrast. And there was an execution theme tied to guidance and margins, right?
Right. And the other thing is that near-term re-ratings were tied to clearer guidance and margin stabilization. For example, Globant's August earnings preview was flagged as a potential catalyst if they show margin improvement. Twilio's better free cash flow and higher current ratio supported upgraded sentiment, but it still needed visible margin leverage. Okta needed to demonstrate how AI monetization would play out at scale.
Quick pause on Splunk. The note said the dataset was missing key public metrics. What was the implication?
Analysts were unusually cautious. Splunk's price in the dataset was about $157, but market cap, consensus estimates, and some PE metrics were absent. That scarcity of transparent, up-to-date inputs expanded the confidence interval around fair value. So the recommendation tone was neutral, more because of missing data than conviction about direction.
Data governance becoming an investment signal. Interesting.
Honestly, I was a bit surprised by this one.
The reports also leaned into balance sheets and free cash flow as differentiators. Say more on that.
Several names were explicitly praised for balance sheet strength. NVIDIA, Twilio, Vertex, Bill. Analysts argued that in the current cycle, cash flow and liquidity matter a lot because they provide optionality for buybacks, M&A, or simply weathering macro storms. For execution-dependent names, a clean balance sheet reduces downside and increases the chance that execution can lead to a re-rating.
Let's move into healthcare. The tone there was durable but event-driven, right?
Exactly. Healthcare names were durable on cash flow or had high-conviction pipelines, but single catalysts could cause big moves. Vertex was described as cash-generative, anchored by cystic fibrosis. Analysts quoted a price around $491 and a price-to-earnings ratio roughly 29 times. The upside was conditional on successful readouts for candidates like povetacicept.
And Intuitive Surgical was in the headlines too. Remind listeners where that landed.
Intuitive Surgical was trading around $405 with a price-to-earnings ratio near 48 times. Analysts stayed bullish on multi-year growth from its installed base and recurring consumables, but they warned a rich valuation and regulatory outcomes could trigger downside.
Eli Lilly also made the list.
Yep, Eli Lilly was around $1,208 with a price-to-earnings ratio about 45 times. The company benefited from strong diabetes and obesity franchises and positive phase 3 data and supportive regulatory signals for Jaypirca. But again, valuation is premium, so continued commercial adoption matters.
So healthcare rewards correct binary outcomes. Big wins, big re-ratings. Misses, big hits. Short and sweet reaction here.
Big move.
And another quick one.
Not what anyone expected.
Back to software. Okta, Twilio, DocuSign, and Bill got a lot of airtime. Walk me through the practical differences.
Okta showed durable revenue growth back into the low double digits and had net retention above 100%, so customers were staying and expanding. But it trades at elevated multiples versus peers. So the question is whether AI monetization can justify that premium. Twilio got a lot of positive attention because its shift toward AI customer engagement improved the messaging around profitable growth, better free cash flow, a high current ratio, and analyst upgrades. DocuSign is leveraging partnerships, like an integration with Perplexity, to push higher value workflows, but has had an uneven liquidity profile. Bill showed a concrete commercial change with a new CRO and a forward price-to-earnings ratio under 11 times. Analysts called that a potentially underpriced opportunity if AI monetization materializes.
So execution equals optionality. If margins stabilize and guidance gets clearer, these names could re-rate.
Yes, and the reports emphasize that guidance and margin commentary are the proximate catalysts. For instance, Globant's upcoming August guidance call was highlighted repeatedly as a binary event for sentiment.
Let's call out some specific numbers that caught my eye. NVIDIA was around $193, Vertex about $491, Intuitive about $405, Eli Lilly about $1,208. Danaher was mentioned near $196. Did I miss anything important on the pricing side?
You nailed the big ones. Also, Splunk's dataset included the price around $157, but missing other public metrics. And analysts pointed out that NVIDIA's valuation had cooled from 2025 peaks, which made it more approachable, at least in tone, than a year ago.
Okay, now a short detour. Methodology and limitations. The report was pretty clear that when key inputs are missing, models get shaky. Spell that out for listeners.
Sure, the research team triangulated price action, analyst consensus, balance sheet strength, and management commentary where possible. But when you don't have consensus estimates or market cap data, like in Splunk's case, your fair value range widens. Some articles were also truncated in the dataset, so analysts cautioned against over-interpolating incomplete inputs.
Right, so practically speaking, what should listeners be watching next week?
Several things. 1. Management commentary and guidance updates. Globant in August is a key watch. 2. Product cadence and monetization metrics from Twilio and DocuSign. Things like ARR contribution from AI products and customer upgrade rates. 3. The biotech and medtech calendar. Any regulatory filings or clinical readouts for Vertex, Eli Lilly, and Intuitive Surgical. 4. Any disclosure updates from Splunk that fill the data gaps. And 5. Macro indicators that could shift valuation sentiment across growth versus defensive sectors.
So it sounds like event calendars and earnings calls matter more than usual.
They do. Analysts said give outsized weight to upcoming calls and product-level monetization metrics. In healthcare, calendar events drive return dispersion. In software, guidance and margin commentary are the triggers.
Let me push you on risk. What are the common downside risks the analysts kept calling out?
Macro slowdown, margin pressure from heavy AI investments, regulatory setbacks in healthcare, and execution gaps in go-to-market transformations. Also, concentration risk for big names. If a few products or customers drive earnings, any hiccup there can cause outsized moves.
We had some contrarian takes in the digest too. What stood out?
A few. Bill's CRO hire was seen as a credible re-rating lever because it's a concrete commercial change tied to AI-native monetization. Globant was framed as a contrarian case, big secular exposure to digital transformation, yet trading at single-digit forward multiples, making it a recovery story dependent on execution rather than a value trap. And analysts noted that the moderation in NVIDIA's valuation from its 2025 highs created a more approachable entry profile for those focused on secular AI demand.
Quick reaction section. Short snippets, rapid fire. First one. Is NVIDIA still untouchable?
Not untouchable, more approachable now.
Twilio. Staying the turnaround?
Positive momentum, watch execution.
Splunk. Buy the rumor?
Pause until we get the metrics.
Love the bluntness. Okay, wrapping up. What are the top 3 takeaways listeners should remember?
1. AI is structural, but monetization timing and margin impact are uncertain. Treat AI as a reclassification, not an automatic growth multiplier. 2. The market split between premium durability names and execution-dependent value names creates differentiated opportunity sets. Valuation matters contextually. 3. Near-term catalysts are clear: guidance, margin stabilization, and discrete healthcare readouts. Balance sheet strength will reduce downside risk in this environment.
Great. And a couple of practical notes. The digest emphasized focusing on upcoming earnings calls, product adoption metrics from AI rollouts, and event calendars for biotech, right?
Exactly. Models should be updated around guidance and product-level monetization signals. In healthcare, treat readouts and regulatory milestones as binary drivers and use probabilistic sizing where possible.
Final quick thought from you. One sentence.
Stay data-driven. AI narratives are powerful, but execution and cash flow are what ultimately move prices.
Perfect. That's a wrap for today. If you have questions about anything we covered, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. Talk to you next week.